Welcome to Noble Insights podcast. And today I have Alexei Rudometkin on, who is the co-founder and CEO and CTO and CMO and Chief Revenue Officer, right, of tradingsystems.com. It's also known as QuantumX Research LLC. And they do a tremendous amount of work in helping people control their own outcomes on their own stock trading and investment strategies using systems. And so I'm very excited to have Alexei on. Alexei and I, we go back to about 2016 when I first had a chance to meet Alexei, when he was implementing e-commerce solutions for companies all over the world and helping align a team of folks out of, it was Kia-based, right? Yeah. So that's where we had a chance to meet many, many years ago. We caught up a couple months ago and found out what he was up to these days. And I thought it was very intriguing and interesting what he's doing. Wanted to just have him on to talk about what he's up to. Alexei, welcome.
Yeah, I'm glad to be here. Thanks for inviting.
You're kind of glad to be anywhere, though, knowing your personality. So I'm grateful to have your time for a little bit. Thank you so much. So, Alexei, you're living in the northern suburbs of Chicago, right?
Yeah. A smaller northern suburb, like a 15 minutes drive from O'Hare, if somebody cares, if they know where it is.
Your accent does not sound like a northern Chicago suburb accent. So are you from Wisconsin originally? Where are you from?
Originally, I'm from Russia.
Russia.
Right? So that's the reason, again, why we get some people from Ukraine in our prior life and the prior jobs that we did together. Because I had ties, because Russia was to be not just Russia, but USSR. So I am a product of USSR. I came to US in 1998. So it's been 27 years ago and a half, to be exact. Yeah.
Incredible. So you came over here. What did you do? What brought you over to the US?
Well, I mean, I was graduating from the college. I was getting my master's degree in the nuclear physics master's degree, for that matter. And I had a choice. Either I need to work for $500 a month at the power plant, nuclear power plant, or I could get a salary as the programmer, as a software developer in US. So my professor recommended me, basically said, hey, do you want to go and work in the US as I was graduating? I was like, heck yeah, off I went.
And it was more than 500?
Nuclear physics kind of a route for the programmer route, because it was my hobby. And he knew it was hobby because I was asking him a lot of questions. So he got good recommendations. So he recommended me to work here. So I worked at
then nuclear physicist path brought you to software development, right?
Yeah, and software development. But I was always to have the scientific mind and the academia approach, because my route over there was the PhD route. I was aiming for PhD, but I kind of ditched it all and said, okay, you know what? I will work here. I would rather make money instead of just be smart and not make money at all.
I'm just curious, what was your monthly salary in the US when you started? It was more than 500, I hope.
Yeah, it was a $40K to begin with.
That's great.
1998, remember? I'm an
H1B. Great money.
At the time was basically alien worker, it's called. So it was, and then in the first year I was already getting 52K. So it's like I ramped it up. But at the time it was pretty cool. And especially, especially living in Kalamazoo, Michigan at the time, which is not even suburbs of anything. It's a small city in the middle of Michigan.
Yeah, right? I've been to Kalamazoo.
Yeah, so it's pretty good to make money.
They have one tall building in Kalamazoo, if I remember. At least when I was there.
I was not even in Kalamazoo. If you know Kalamazoo, it has two parts. There was a 94 highway, and there was a Kalamazoo north of it, and there was a Portage underneath it. I was living in Portage. So
okay.
Specific, which had no tall buildings whatsoever.
No buildings. Okay.
I mean, had buildings, but no tall buildings.
No tall ones.
None of them will tall. Yeah.
Short buildings. All right. So you were in the short buildings in Kalamazoo. And then you did that for a while. And then what did you do after that?
So I moved to Chicago in 2001, in January of 2001. So literally almost 26 years ago, this coming January, to work for a small startup company. And I was doing all kinds of crazy stuff. I was always specializing in optimization on the software side, performance optimization. And we did some very cool things at the beginning. There was a company, it's called OneTravel.com. I don't know if it still exists or not. They were competing with Expedia at the time. So we're working for them as a consultant. So we've created the Google Maps type of software, which didn't exist yet. There were MapQuest, if you recall, back then. There were some other map mapping software, but there were none like Google Maps at the time. So we've created an analogy of the Google Maps, and I was a part of it, like getting the census data, drawing it, rendering it, picturing all that stuff, doing the directions, route. It was very scientifically built kind of a thing, and a lot of optimization. So I was doing that cool stuff. And then I moved along, get into another industry, healthcare industry. So I was working with a healthcare company. Then after that, I moved to another company, which was automotive industry. So I was working with fleets of cars, automotive. Then I decided, hey, why don't I open a new business? In 2006, we opened a new business while I was working for another company, just as a side gig, building UAVs. The UAV is the unmanned aerial vehicle, aka drone. Right now, everyone knows drones, but back in 2006, nobody knew drones. So we were like pioneers of that, and we decided everything has to be done completely from scratch. So we were developing literally all the hardware, like the actual hardware. Forgot the name of that even an instrument, which measures the oscillations of the signal, like a zeros and ones, but you can actually see this whole graph. And I was hooking up the camera to the actual controller and seeing that it gets the results. And we almost made it working. We even got a grant from Illinois by Blagojevich at the time. He was the governor before he got into jail, but he gave us grant because the governors of Illinois, they were known to go to jail a lot, one after another. So
yeah, Chicago politics is quite famous worldwide.
Especially like when Blagojevich was trying to sell Barack Obama's seat for $50,000. That's what got him into jail, basically.
Right.
When Barack Obama went to be a president, right? That's why he was selling the seat in the Senate.
Right.
Anyway, so that was another thing that to do while pursued my career in e-commerce at the time. That's how we basically eventually met, because I joined Lions Consulting Group back in 2009, actually 8. I joined them in 7, then kept on going. And in 2010, that's when we started outsourcing with the Ukraine team.
So you had joined them just like 4 or 5 years after they founded, right?
Lions, I think they founded, 2003? So I
Something
joined
like
in
that.
2007. Yeah, I joined in 2007.
Okay. Oh, very cool.
I was oblivious to the market, by the way, at the time. So when I joined them, literally in 2007, right? It was the peak of the market, if you think about it. Because in 2008, the market just took life. And I'm like, what's going on? Because I see that when I joined, we had 30-something consultants. I was one of those consultants. And then in 2008, I'm one of 5 consultants. The rest just disappeared because the projects disappeared. The whole office was like lively, and there were so many people. And then we have just cubicles and nobody. You can choose any cubicle because there's nobody in the office. It's the old office that we used to be on the Superior Drive. You joined later, so you don't even know.
Later, I missed that one.
Yeah, in Chicago. So basically,
I remember stories about it. Yeah, I remember stories about it where, Rich was worried about where payroll was going to come from. And
we had to fire all the administrative. There was like 2 girls left from administrative staff. And only the founders. Rich, Dave Parr, and there was another guy, Steve Kroll. I mean, he was still there, but then he was gone as well.
And they were doing other things besides e-commerce, though, weren't they? They were doing other types of development work.
Well, then they were just consulting company. They were doing whatever. And then they decided that, you know what, with that economy, when the economy is just tanking, what's not going to tank? Well, e-commerce is still going to stay, right? People still want to buy something. So they decided to, okay, you know what, we need to narrow it down, concentrate on just that, and go with the e-commerce. So they went into e-commerce. And I happen to be in e-commerce space myself with that.
Okay.
So that's why I kind of stayed out of this 30-something consultants. I was one of them because I was doing the e-commerce. The rest of them, they were doing non-e-commerce stuff.
Okay.
So they all fell off.
Wow. I saw on LinkedIn that I think it's TJ. He's a guy that was with some of our competition for a while. I'm trying to remember the name of the company now. Pixel, maybe? Pixel Media. And he and Rich do a podcast, and then they had Dave Barr on last week, or week before. Nice. I think I'd like to listen to that, catch up on it. So you've basically gone mapping to healthcare to automotive, and now UAV.
Then e-commerce, and then I worked for 10 years in e-commerce. All kinds of e-commerce sites.
But across industry. So you're getting like a really broad education on industry-specific knowledge and strategies. So now you're in e-com and then doing B2B, B2C, a little bit of both?
Yeah. E-com, I went through 100, and I think I counted at one point in time. It was like more than 120 projects.
Wow. And it was
Actual
mostly Magento,
implementations,
right?
not just the
Or did you,
sale. Yeah, it was all Magento for me.
all Magento?
Yeah, I mean, I did a couple of Demandware at the beginning, which is now called Salesforce Commerce, right? But at the time it was called Demandware. So I actually started from Demandware, and then I switched to Magento. In 2008, I did the Warner Brothers website, Warner Brothers for movies. That's 2008. That's why I'm saying it's just like before I started doing Magento, and that's when I was doing Magento all the way to 2022. That's when I quit. Said, you know what, I'm done with the corporate world. I want to concentrate on the company and do the stocks instead. Because my story, again, is the people who were in Ukraine, right? They were part of another company that I was in. So I was sitting in two seats at the same time. So I was part of the company, it's called Sparetech at the time. I mean, they're still active, I think, with Capgemini. I was a co-founder of that company. At the same time, I was working with the Alliance Consulting Group and then Capgemini. So the idea was that I'm helping to develop it, and I'm a chief architect at Alliance Consulting Group, and the technical architects. I'm helping with other projects. But the developers, they were making a lot of things behind the scene of actual implementation on the Sparetech side. So everything is great. But then in 2015, my business partner, he decided that enough is enough. He wants to buy me out. So he bought me out. And when he bought me out, I'm sitting on a bunch of cash. All of a sudden, found myself sitting on cash. So that's where my current story begins. Because when I sat on my cash, I said, okay, what do I do with that cash? Before that, I didn't have that much cash. I mean, I had some accumulation, some savings, but all of a sudden I have like a big chunk of cash. Okay, so what do I do with that cash? Well, two things I can do. Well, I can invest into the banking system, like somewhere, like find the bank where I can put the money in. So I said, okay, let me just invest into the mutual funds and then open up the account with the bank. So let them invest because they're professionals. I mean, they know better than me, right? So let me just invest it all over there and here at the same time, which was great. So by 2017, I had it invested, like till end of 2016, had it invested over there in the mutual funds and had invested with the bank. In 2017, I just didn't know at the time, was the smoothest ride in the market. Everything was going up with like barely any budging down, just going up and up and up and up. Like the smoothest ride. The whole year, you feel like you're a genius because, I mean, you sneeze it, you make money. You sleep, you make money. Okay, not a big deal. So let me put it out, like all the money. And then here comes the 2018. The first beginning of the year, bam, it goes down. Market goes down, recovers. So that was my first kind of like a red flag. Like, oh, something's not right. I mean, it's not a smooth ride anymore like it was 2017. The whole year was a nice smooth ride. But all of a sudden, my money is kind of like can disappear quite fast. And then at the end of the year, second bam, the market goes down at the tariff wars with China at the time. Not the current tariff wars, but back then tariff wars.
Give me the month and year again of when that second one was.
The second one, I think it was October in 2018, I think.
Okay.
That's when it started to go down. And it went down all the way till the end of the year. So I'm sitting with my money manager at the bank right after Christmas, kind of like a yearly review. So he has one of these brochures, like a printed out, colorful with the pie charts and these numbers and the highlights. Everything is so cool. And he has number after number lifting. It's like a 20 pages or 40 pages of some brochure, basically, which is specifically tailored for me. Like everything looks so great, except for one little thing. He's patting himself on the back and said, look, the market went down 20%. But your portfolio went down 18.5%. You should be proud. You should be like ecstatic. Like, do I need to be ecstatic for that? That doesn't sound to be really to be ecstatic for, because I'm also paying you 1.1%, I think, at the time the management fee was. I mean, I had lots of money, but not tens of millions of dollars. And then they reduce the fees if you have lots of money with them. So like, okay, great. So in other words, you saved me maybe, just maybe, about 0.5%. Eh? But my 20% pretty much went down. So okay, if I had $1 million, means that I lost it to 100K right here, right now. If I want to get that money and put it somewhere right now or use it for anything that I want to use, I'm not able to. Then I open up the charts, look at the charts, like, oh, I was oblivious in 2008 myself. As I said, I was kind of like working my way through the consulting world and seeing like I had my smaller savings, but they were in certificate of deposit, so I didn't even see the dip in the market at the time. I was playing with more of like a rolling certificate of deposit strategy, which was not making a lot of money, but still was making something. So I didn't see that dip over there. It's got to be a better way. So I started investigating, and first I found the day trading side of things. So I started pursuing day trading, and that didn't go all that well.
Because basically, Alexei, at this point, you're just like, look, no one cares about my money more
Yeah,
than me,
nobody cares about your money,
right?
especially something like the money managers, because all they do care is that how much money they keep with them so they can get their management fees. That's
Yeah.
literally what they care. I mean, yes, for them it's good if you can make more money because then the management fees will be higher. But because it's such a small percentage, the percentage of how much they're getting from you is so tiny that it's not the make or break for them. They're looking for the volume. They want to make sure that basically these money managers, they're not really money managers. They're just sales people. They're trying to sell you a story. That's why they
Yeah.
have this thick brochures, nice colorful pictures. It's all about the story that you keep the money with them, but not really. It's not really there to protect you or
And
help you.
what's their secret sauce that they can do that, me as an average consumer, average investor can't do?
Well, what they can do, I mean, officially they can have their supposedly they backed research. So they diversify because that's what they do. They're supposed to be diversified. If you look at their portfolio, they will say, "Oh, look at that! You have this much in S&P 500 in large cap stocks. You have this much in the small cap stock. This much in the mid cap stocks, and this much you have in international exposure. This much you have in your bonds exposure. This much you have in alternative investments, something like real estate and blah 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 stuff. And then you have this. Like basically, it's all fancy words." But it all comes down to they just diversify for the sake of diversification so it looks and sounds good.
Yeah.
But behind the story, there is no actual substance, to be honest. Yes, they can kind of smooth things out, but they don't really want to do too much work to do that.
Yeah.
It's not an
Do as
area.
little as work as possible. Keep their 1.1%.
I mean,
Make you
it,
grow a
it, it
little bit.
varies, right? The 1.1 to 2%, all the way to like 0.5% if you have like I don't know, hundreds of millions with them. So it varies
Okay.
on how much money you invest with them.
So I appreciate you walking me through that. So keep going. And then you basically are researching day trading. And then
Yeah,
what
so
happens after that?
yeah, so like when I started to doing day trading, there was a chair over there. I used to sit in that chair waiting for the market to open, sweating profusely, dreading the open market because I know that I need to put on the trades, but I have no idea if these trades are going to be good or bad.
Yeah.
You're literally with the market, you never know, which leads to another key problem that people see in trading: and paralysis by analysis. So they sit at the computer, and especially when it's a day trading, they're trying to make a decision and they don't know if to pull the trigger or not to pull the trigger, because if they're ready to pull the trigger, but at the same time there are all kinds of contradicting information coming in and you don't know, so you're trying to analyze, and you miss your move. And if you're stupid enough, you actually will execute right at that point and say, you know what, I will just execute anyway. Then you get in right at the wrong time, and now you have all kinds of buyer's remorse and trying to get out now with a bigger loss than anticipated because you didn't really know, or you don't even know what it means to do the position sizing, meaning that how much you need to buy, how much you need to sell, guessing based on whatever you're guessing. So it's not as easy as people make it sound. So the day traders is a different type of breed of people. It's like these people who have less emotions, but it's like in a scale of from 0, when you're dead, you have no emotions. Okay, you're 0, you're literally dead, or 10, where you're in just a full panic. Okay, you're full panic mode. The day trading, you're operating around 8 or 9. So the professionals who've been doing it for years and years and have been looking at it, they know their drawdown, so how it operates. They operate probably on the 7 or maybe 6 level over there, but it's still high.
Yeah, their cortisol is still off the charts, it sounds like.
That's why they even came up with these fancy names. They have, what's the ulcer index for a system? Quite literally, that's the name, one of the metrics. What's the ulcer index? It's like how difficult it is to trade because of this gyration of that it's doing. So it's like the ulcer index. So that is why, like, when I traded that, it was literally not fun. It's not for everyone. Like, literally not for everyone. So I found for myself, like, you know what? I would rather do something more like a swing trading where I need to hold something for longer, but I need to have clear rules. And clear rules led me to, like, I need to have clear rules. Literally clear rules of how much to buy, how much to sell, when to buy, when to sell, right? Which led to the realization, well, I need a system. I need a strategy, which is good. You need a strategy. You need something like a boundary, because market, think of it this way. Market is the ocean. It has water. You can sail this way, that way, any other way. You can sail any way you want. The wind go down. You cannot go up though, but you can sail any way. But the waves sometimes completely looking sporadic, but in reality, there is a flow, right? There is a current, or there is a wind blowing in one way. For you to not go against the wind, you actually need to go along the wind. This way, it's a little bit easier. So you need to have kind of like be more restrained, have more boundaries. And the systems, the strategies, this is what keeps the boundaries for you. So you are not in this completely open ocean. You're in at least a pool where it has the sides, has the lanes, so you can know that I can go this lane and turn around, come back this lane, right? So you have more boundaries, and you need to create these boundaries yourself. That's what the systems are and the strategies are. That's the realization number one, though, right? That's good to have, but when you realize that, well, in order for you to follow a strategy, it's not as easy as it sounds even here. Even with the boundaries, you still have a lot of which is called luck versus no luck. It's like, basically, in other words, you have almost a 50-50 chance that you're going to fail or win on any single trade. We human beings, we don't operate on the probabilities. We operate on either it works for us or it doesn't work for us.
Right.
Either sky is falling or it's still there. It's not falling. Right? We kind of don't operate like, there's a 60% probability that the sky is going to fall. Like, what does it mean? How do you internalize that there's a 60%? What if there's a 55%? Is it better? It sounds better, but in what sense? Like, we cannot internalize the probabilities. So we need ability to abstract ourselves and say, you know what? I do not need to look at the market all that often, because if I do, I cannot really comprehend that the trade is failing does not mean that I failed. It just means that trade has failed. It's one of these probabilities that you just, like, if the system fails 40% of the time, it can be one of these 40% of the time failure. It doesn't mean that the system is wrong or it's bad. It just means that, okay, this particular trade means nothing. And when you place the next trade, you should forget what the previous trade did. Because if you don't, and that's what we humans do, we put a lot of emphasis on the previous trade. We will be more cautious if it failed before, and we'll be more reckless if the one before was the winner. So we do like the opposite of what the market actually wants. You need to be completely kind of think of it as a mechanical, right? You need to be completely agnostic to what happened before.
But how does a human being do that? Because it's probably one of the most difficult things in the world for us to decouple our emotions from our money. So like, how does one become unemotional about something that's so personal and people are terrified of losing?
Exactly. So that's where the next realization came into play. It's like, oh, I need to have a suite of systems for different market conditions, basically the systems which work at different times. And I need to get it so that I can remove myself as far as possible from the market and not be close to it, so that I don't watch it like a hawk. Because if I only have, let's say, 5 positions, like I'm invested into 5 stocks, I guarantee you'll be checking what's going on with these 5 stocks every single day. What's going on? Oh, this one went down. Oh, this one went up. Okay, great. When you have 200 positions in your portfolio, you're no
Yeah.
longer attached to any single position anymore. So
Right.
it's like one way to deal with it is basically you create so many different systems and so much diversification that you lose the attachment to any single position, any single stock, or any single ETF, whatever you're working with. And because you do lose that, you are now starting to operate more on the probabilities versus on your emotions. So emotions are still there. Remember that scale, 0 to
Uh-huh.
10? You will be operating still about 4 to 5. You're trying to get down to like 3. You will not be dead. You're not going to be 0. You will not be completely unemotional. But that's,
Right.
by the way, another point to this, to how to fight it. Like what people do when they invest money into the hedge funds. The
Mm-hmm.
hedge funds, for a reason, report to you only once a month. So you only see the once a month number at the end of the month,
Yeah.
how much they made or lost, so that you don't see what was going on in between. Because if you do, you'll be freaking out. Otherwise, you don't freak out. You just see only monthly number. So you, first of all, when you saw the number, even if you're upset, it's only going to take you another month to see the results of it. So
Okay.
you will cool off and we'll look at it with less emotions than what you started with, right? So the one way to fight it is, as I said, have more systems to begin with, but they're not random. You don't just pick random because there are so many things that we see people do. I call them the systems collectors. So what they do, they collect systems. It's like the Hector the collector. They collect all the junk, hoping that somehow magically the systems will do fine for them. But what they don't verify is, are these systems working in the same fashion? Meaning that if the market goes down and system number 1, system number 2, system number 3, and system number 10, they all go down at the same time when the market does, it means that they're very correlated. It means that they're acting the same way as the market does. So even though you diversified, you really didn't diversify at all because when the market falls, they all fall. So you need non-correlated systems. But how do you do that? I mean, that's why we have our mentoring right now where we discuss, okay, there is long-term trend following systems. So systems which allow me to go and hold something for a long time. Hence the name, long-term trend following. Then we have mean reversion systems, so something which reverts to the mean, meaning that it acts on a shorter time frame. You hold something for 2, 3 days, maybe 5 days at the most, and then you get out. But you make money in these little tiny motions. Not tiny, it's not day trading, right? Actually, we do have day trading systems as well in the same picture. But we have all kinds of hedges as well. So something which allows me to protect from panic, from catastrophic moves, or for inflation. So we have specific hedges to make sure that you can prop it up and have what is called non-correlated systems. So
Okay.
they're not all falling and all rising. Zigzag.
It sounds complicated.
It
So
is. It does
if
sound
I'm a
complicated.
novice, that's like, that's I'm confused by the currents and the waves and the ocean flow and all that. How does someone who is maybe not as familiar as you are with the stock market intricacies, how does someone get started in this kind of a trading environment?
Well, unfortunately, it's not as easy, right? It's not as easy as you think, because for you to start on your own means that you really need to understand how to create this type of strategies.
Uh-huh.
Because whatever you hear a lot, and it probably pops up on your Facebook feed or whatever the feed, like Instagram feed, algo trading, some algo trading, blah, blah, blah. These are not what I'm talking about. These things are more get rich kind of schemes. They promise you, oh yeah, you're going to get 100% returns in a year, which is total BS because it's not really true claim. We're talking about more realistic returns and more a way to protect yourself from the market downturns when the market really goes down. Because as I said, everyone is a genius when it's a bull market. When the market goes up, everyone's like, oh yeah, I made money. Yeah, because you just put it somewhere, it's going to make money. But so how do you start? Well, that's the reason why we exist. So we have books. As an example, I have my book, right? My business partner has a book. I think it's over there in the background.
30 minutes stock
Yes, the
trader.
30-minute stock trader over there in the background.
And
So
that's
yeah,
Lawrence Bensdorp, right?
yeah, Lawrence Bensdorp is my business partner. He is the founder and the president of the company. I am the CEO, CMO, C-level, what you call me, our company. And I created the software for us to actually be able to model everything together. Because again,
Okay.
if you try to model it manually, good luck to you. So
Now, there
really
probably was
intuitive.
other types of systems out there with software that you could go and set trade rules and systems in. So what makes your system different than the other ones that were already out there in the market?
Yeah, that's why I'm saying, because there's all these algo traders that exist.
Oh, yeah.
They say just buy a subscription, invest the money, and you're gonna win. You just keep forgetting that, okay, that's a one system, whatever they buy from them. So it has this a lot of durations, a lot of ups and downs, which are not that easy to sustain. That's why people maybe trade for 3 months and then they said, you know what, I'm out. I'm out of there.
I'm done.
Because they get like 20% down, I'm out of there. Because you have no idea. You buying in a black box, it's almost like this. If you come to me and I say, Josh, you're gonna make $1 million by the end of the year.
Sweet.
Just give me your $10,000.
Sounds like a win-win.
What's your like? You'll probably say like, is he crazy? I mean, how can I believe you? That's like you're just claiming that they're gonna make me $1 million from 10,000. First of all, it sounds fishy, and second of all, it's just not doesn't even sound realistic, right?
Right.
But if I say, okay, I'm gonna make 20,000 from your 10,000, sounds a little bit more realistic. But at the same time, okay, how? You're gonna ask me how, right? So you want to know the underlines, but I will say, no. You just invest the money and hope for the best. This is what the black box approach is.
Yeah.
When you go to these guys, the algo trading guys, you invest the money and you hope for the best. Literally, that's pretty much the same approach, right? So without understanding what's going on behind the scene, it's very, very hard for you to not give up on the systems. So that is why, yes, there is a software out there, lots of these algo trading guys. But what they do, they say, okay, you can model any idea under the sun. Any idea. Complete flexibility. Okay, great. But no direction.
No direction.
You go.
And you're
Go
providing like some proven systems that you've tested and tried and okay.
But besides providing the systems, what we do, we don't give you the fish. We explain to you how to fish yourself. So here's the fish and how you catch that fish yourself in that same ocean. I don't know why I keep going back to that ocean, but
it works.
Analogy, it works, yeah. But the idea is that it's not just, hey, here's the system and go knock yourself out. Here's the system and here's how you can create your own systems. What we do, the tagline is, we make your own, you become your own hedge fund manager and hedge fund. What does it mean? Well, it means that you will be able to create your own systems yourself, and you will be able to run them yourself without delegating to anyone else or giving the money to somebody else, like paying the management fees.
And what kind of results have you gotten for some of your clients?
So typically, what we are aiming is around 30% returns on average, keyword on average. It's not 30% returns with 10 to 12% drawdowns, which means that on $1 million account, it should not go below 900K, right? It should not lose more than $100,000 on $1 million account. Because again, all these trading systems that you see out there, they claim a lot, like and say, okay, we'll have 30% returns. Yes, with the 50% drawdown. Will you be able to actually sit through a 50% drawdown and have that much confidence to actually sit through and say, oh, you know what? Yes, it's going to make 30% for me. Eventually, if I wait just long enough.
You know how long it would take to make up for a 50% drawdown? How many years it would take?
100% back.
Yeah, right? That's a long time.
It's a long time.
So, okay, that's fascinating. And then let's say that someone came into a large pile of cash, whether it's they sell a business, it's inheritance, something like that, which is, quite probable and possible for a lot of people that are listening. They come into a large pile of cash, somewhere between, let's say, $1 million to $20 million. What steps should they take? Because most people don't come into that kind of cash all the time, right? So it's probably new to most people to have that kind of cash. So let's say they get somewhere between 1 to 20 million. What should they do at that point?
Well, there are two routes. I mean, obviously, what I know people doing sometimes, again, I'm not trying to say come to us immediately, right? But what they do, they hire family office kind of a setting, especially if it's a bigger cash. Let's say they have more than 10 million or 20 million. They probably hire another company which runs the family office. So either they become their own family office or they join these companies which can do shared family office setting.
Got it.
It's the people who don't know what to do with the money and don't care how to manage the money. They just want somebody else to manage their money.
Okay.
Because, I mean, going just straight to the bank, it may not be sufficient enough because, as I said, bank is just specializing too narrow and you need to be broader. This is the type of people who come to us because they want to learn how to create these returns, 30% returns on average, right, over the longer period of time, how to protect the money so you don't go down more than 10 to 12%, versus the market can go down 50, 80% easily. So how do you protect yourself? Like back in April, the market went down 19%. So how do you protect yourself and don't go down as much, even for your retirement account or non-retirement account? Again, how do you manage that? And this is where we come into play, and we talk about on the software side how it's possible because we do have the software. I personally, it's called QuantumX. It's not retail, it's not for sale. It's part of our mentoring overall because we want to make sure that you don't just get the software, you don't just get the fish. You know how to fish yourself. So how to actually use it, how to create the systems, and how to run it so that you have confidence, not to give in to your temptation, say, oh, you know what, doesn't work. It does work, especially if you know how it works, but you need to be able to sustain any kind of drawdowns because everyone is happy. Like nobody will complain if they make money. It's only when they lose money, right? So everyone is, I'm good. Nobody's like, oh man, I made too much money. What do I do with that? Can you just take it away from me? Like nobody does that, right? So,
got it. All right.
That's again, it's not as easy. That's why we have the books again, once again. So if you read the books, my book, the 30-Minute Stock Trader book, it gives you a lot more explanation of how it all works. So if it really clicks with you, you can obviously place a call with me, and I can walk you through, put a demo, show you how it works and what it is. It still requires upfront work, but not as complicated. It just sounds very complicated at the beginning. Like, oh man, I have to have that many systems, so I have to have this non-correlation. Just very scientifically sounding, but in reality, there's a lot easier principles behind the scene over here. Yeah.
And also, it sounds like it's a mindset thing too, right?
Oh, yeah.
There's a lot of psychology that it's mostly mindset. Okay.
Yeah. Trading is about 90% psychology, 10% actual strategy.
Fascinating. Well, so for people to find out about you, they can get your book on Amazon or wherever that's sold, and then
it's on Amazon right now. Yeah.
I think in the book you also have ways to get in contact with you, but that's basically www.tradingsystems.com. People get in touch and they can sign up for a demo and just have a chance to have a conversation with you about
they can
options.
also reach me directly, Alexei at tradingsystems.com as the email. So Alexei spelled as ALEXEI at tradingsystems.com. It's a little bit different than the Alexei that sometimes can misspell it. Otherwise, they can reach out like that. And we even have our YouTube channel, and you can probably post along with your podcast eventually.
Sure.
We have a YouTube channel and have a lot more description, again, how these things work and explain a little bit more in details as well.
Great.
But otherwise, the easiest thing is to just book the demo call, walk you through, and especially see if it works for your particular situation. Not just hypothetical, but more exact one. Like, is it for your account? Will it work for you specifically? If it's because it does require investment. Like if you only have $10,000, unfortunately, it will not work. It's just not enough. Even with a 30% return, it's $3,000 per year. It's not that much for you to return.
We're talking like someone with at least $1 million, maybe minimum 500K to see a big difference, right?
Yeah, it's like people who really clicks with on this part. It's people who have at least 500,000 of liquid assets.
Okay.
So net worth of 1 million or more, but liquid assets about 500-ish. Then it's easier to really see why it will be a good investment for yourself.
Thank you for joining. Really appreciate it. Great to hear about your company. Please reach out to Alexei and just have a quick conversation with him and see if this is a good fit for you. And my friend, I'm sure we'll talk soon.
Thanks, Josh. Thanks for having me.